Stocks have been under severe pressure lately, flirting with a bear market for the past week. The S&P 500 is now 18.6% below a record closing high set in early January and more than 19% below an intraday all-time high reached earlier this year, essentially a stone's throw from entering what analysts call a bear market, or a 20% drop from a 52-week high. And despite the high volatility accompanying the crash, hedge fund manager Francesco Figlia says a drop in stock prices was long overdue. Here's why.
I don't think it's a severe market crash, at least not yet. I think it is actually quite mild. It is both very moderate and very overdue type of market adjustment. If you compare the S&P and the Nasdaq levels to the levels pre and post-COVID, this is still much higher than then. So it's just eating on a bit of the gains of the last year and a half. So I think that it can definitely continue. In any case, if anything, I think that the equity has shown a very moderate reaction. The movement in the bonds and bond yields has been more severe, more pronounced. You have had the interest rates in the US on the 10-year Treasury moving from as low as a 50 basis point to currently 300 basis point. And that has definitely been one of the worst years on record for government bonds.
And indeed, investors have been focused on the rate hiking cycle this week, trying to decipher whether the Federal Reserve will continue with an aggressive rate hikes and whether the European Central Bank will decide to follow suit. But even if the market downturn doesn't faze investors for now, it still leaves plenty of room for doubt. The situation is reminiscent of the dotcom bubble, which took place at the turn of the century, a big conundrum for whoever is investors in cryptocurrencies and high-flying tech stocks.
Some of the tech darlings, the tech stocks, some of also the cryptocurrencies are like 60 to 80% off the highs, and that can compare to what has happened during the dot-com bubble. I think that similarly to that moment in time, there is some overshooting on the opposite side, meaning that before there was excessive valuations, now there is probably too much on the opposite side. We have some good technology plays that they used to trade at a huge multiple on revenues, but today they trade at one-time revenue, which is crazy for a growth stock on the opposite side. So there are some similarities to the dot-com crisis.